Financial turmoil, and markets are no exception. I specifically want to ask you, do you see this as the same turmoil in 2008, or is this a different turmoil, considering monetary policy in the last 8 years hasn't been able to rev up growth all around the world?
Well, we're constructive. We're constructive on the world of macro investing, but I would say moderately and modestly so rather than euphorically so. And if you do a sweep of the world, start with the US, Europe, both of which sequentially are looking stronger, but the wild card is clearly China and what that means for emerging markets.
So I'm going to speak to you about China in just a bit, but I specifically want to ask you on emerging markets as a basket versus the developed markets. And you rightly said that US and Europe are beginning to go. It's emerging markets that will be a pressure point, that will be a pain point. What is your outlook on emerging markets all through 2016?
So if you zoom out of the typical markets horizon and talk about the theme of Davos this year, which is the fourth industrial revolution.
That's right.
There's clearly something massively structural going on. And we believe that on the margin, the fourth industrial revolution would benefit developed markets more than emerging markets. And at the risk of oversimplifying it, what that means is that low-cost labor doesn't provide an economy as much of a relative advantage as it used to do in the past. And there are things that can be done about it, but that is, in the backdrop, a structural headwind for emerging markets. From a market's point of view, the immediate question is, and again, emerging markets is a mixed bag, different countries have different profiles, but one way of looking at it is that if you as an emerging economy are selling into China or any economy where they're not buying as much as they used to, so that determines your earnings.
That's right.
And are you borrowing in US dollars and US rates are about to go up? The US dollar is expected to strengthen. So are you stuck in a bit of a double whammy where your earnings are potentially impaired and your cost of funds are potentially rising? And the combination of the two provides challenges.
So you're essentially saying here that weak growth domestically, weak exports, a currency mayhem, this is structural pain in emerging markets.
It's a structural pain. The growth model needs to change. The sources of growth, the engines of growth need to change. Western economies, the kind of growth that the US is exhibiting, are not as kind to emerging markets as it used to be. So trading out of slow growth, exporting into Western economies as the sole engine of growth is going to be challenged. Whether that's finished products, electronics and so on into the Western markets, or commodities into China, which has historically been the largest marginal buyer.
Just want to pick your brains on the whole risk aversion bit as far as emerging markets as a basket is concerned. And I specifically want to talk to you about the fact that do you see this as a prolonged risk aversion period, or do you expect this to subside, and at what period?
So risk aversion is not just about emerging markets.
That's
there
right.
are lots of uncertainties right now. And part of it, again, goes back to the fourth industrial revolution backdrop, which is really multiple revolutions happening at the same time. Changes to economic systems, technology disruptions, social systems, political systems, belief systems being challenged. And so there's lots of uncertainties around. Globally, there is a very strong disinflationary trend. On that backdrop, in emerging markets, you could look at a few factors when you assess a country. You could look at how much fiscal space do they have. If they happen to be oil importers, then this has been a great advantage, a period of opportunity for them.
Right.
Fuel subsidies are down, current account deficits narrow, so that's been good for you. If you're an oil producer, so the government relies on income from the oil sector, then this has been a negative for you. So how much fiscal space do you have is one. How much leverage do you have in the system? One of the observations the last few years is the US has done a very good job of deleveraging. The private sector is delevered, whereas emerging markets by and large has levered up. So how much space do you have from here on to jack up credit? And then how much of that credit is from the external sector? How much of foreign currency debt is due in the short term? And then lastly, perhaps the most crucial point is what is the outlook for structural reforms in your respective economies? And structural reforms have a political dimension, a political economy dimension to that. And there the outlook is different for different countries.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.